Welcome to the Deep Dive.
Glad to be here.
Today we're jumping into venture capital trends for the first quarter of 2025, specifically looking at the U.S. and Canada.
Yep, we've got a professional report guiding us. Pretty detailed stuff.
Right. And our goal here is really to pull out the key insights, what's actually happening on the ground in North American VC right now.
Exactly. It gives us a snapshot of how investors were acting, especially with, well, everything going on economically.
Okay, so let's start with the big picture. The report calls it a cautious start. Subdued investment volumes compared to, say, the peak years.
That's the main takeaway, yeah. Subdued is a good word for it. Definitely not the frenzy we saw a couple of years back.
And what's driving that caution? The report mentions a few things.
Uh-huh. It points to the usual suspects, really. Macroeconomic uncertainty is a big one. Persistently high interest rates, that's key.
Make borrowing more expensive, slows things down.
Right. And also a tight market for exits, IPOs, acquisitions. They haven't been easy, so investors are thinking more about how they'll eventually get their money back.
That makes sense. Less certainty, more risk aversion. Okay, so how did the U.S. and Canada compare? U.S. funding still higher overall, I assume?
Oh, absolutely. In absolute dollar terms, the U.S. is still way ahead. But what's interesting is the report says both markets felt similar downward pressures.
Especially at the early stages, seed, Series A, that kind of thing.
Exactly. That early stage where companies are just getting started or scaling up initially, that seems to be where the caution was felt pretty universally across both countries.
So even though the scale's different, the underlying sort of climate affected both newcomer companies similarly.
It suggests that, yeah, it points to maybe a broad trend of investors being, let's say, extra careful with brand new ventures right now, needing more proof points, perhaps.
Okay, but here's a key difference that the report flags.
Yeah.
Deal size. It mentions Canada lacked mega deals, while the U.S. had these huge multi-billion-dollar raises, particularly in AI and health tech. That seems significant.
It really is. It underscores that U.S. dominance, especially in globally leading tech sectors. I mean, those massive rounds can skew the overall funding numbers quite a bit.
So while Canada might have a healthy number of deals, the really big checks are still predominantly being written in the U.S.
That's what Q1 suggests, definitely. It reinforces the U.S. as the hub for those kinds of transformative mega investments, particularly in hot areas like AI.
Speaking of hot areas, despite the overall caution, the report says some sectors were still resilient. Which ones?
Yes, and this is important. Even in a slower market, money is still flowing. The report highlights AI, fintech, and climate tech.
Okay. AI, no surprise there, I suppose.
Right. Seems like the belief in AI's potential, especially generative AI and its applications for businesses, is still incredibly strong. Investors see near-term value.
And fintech and climate tech holding up too.
Seems so. Fintech continues to evolve, and climate tech has these huge long-term tailwinds, policy support, societal pressure. So investors are likely still seeing essential innovation happening there.
Got it. Now, there was a slightly odd bit in the report about investor behavior. It says, investors continued to, and then it just stops.
Yeah, that's a bit frustrating, isn't it? An incomplete thought.
What do you think they were getting at, given the context?
Well, you have to speculate a bit, but based on everything else, investors continued to be highly selective, maybe, or perhaps continued to focus on due diligence.
Right, digging deeper before writing checks.
I think that's the most likely interpretation. In a cautious market, investors naturally spend more time vetting deals, focusing on fundamentals, path to profitability, that sort of thing. The incomplete sentence is a bit of a data gap, though.
Okay, understood. So let's quickly recap the main points from this deep dive. Q1 2025.
Yeah.
Definitely a cautious VC landscape in North America.
Lower investment volumes overall, yep.
Both the U.S. and Canada felt similar pressures, particularly for early-stage startups.
But a key difference in deal size, with the U.S. landing those multi-billion-dollar rounds, especially in AI and health tech, while Canada didn't see those mega deals.
Right, and despite the caution, sectors like AI, fintech, and climate tech showed resilience, still attracting capital.
Precisely. It's a market that's clearly adjusting, being prudent, but still placing bets on key innovation areas.
So the final thought for you, our listeners. How might these early 2025 trends signal longer-term shifts? Think about where the money is flowing, even now.
Yeah, what could this cautious but targeted investment mean for the kinds of companies and technologies that really gain momentum over the next few years?
Something to keep an eye on as the year progresses. Thanks for joining us on the Deep Dive.